Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you are incredibly well and you've had a really good week. All fine here with us. Another busy week at Mortgages for Business with remortgage applications, more rate withdrawals, more clients looking to get in quick and secure rates, keeping us on our toes. And apologies, as you can hear, I'm not terribly well this week. It's not COVID, it's just a good old-fashioned summer cold for me. But apologies if I sound a bit grotty. Now, in terms of what we've got for you this week, we're going to do our usual update on what the lenders have been up to. I'm then going to talk to you a bit about the impact of Boris Johnson's resignation and how this is going to impact landlords. And then lastly, the Halifax have just released their latest house price index. So we're just going to chat through the results of that and what is going on with the housing market just now. Okay, some more repricing has been happening this week. It doesn't feel like it's been quite as prolific as it has been in previous weeks. Why is that? I feel that the swap rates have settled down. They've actually eased ever so slightly as well over the last few days, which is meaning that lenders are able to kind of stabilise their funding costs, which is then slowing down the need to reprice ever so frequently because, you know, things are just a bit more stable. So what's happened in the last weeks, we've seen Santander make rate increases of 0.7% across their whole buy-to-let range. Gatehouse have increased rates by 20 basis points. Bank of Ireland increased by 30 basis points. We've seen rate increases from Metro, TSB and Skipton and Lambay, as well as Keystone. We've seen Fleet increase their rates, and also they've made a change to the rent to interest calculation for individual personal borrowers. So what they were doing previously is they were stressing the rental calculation at 125% coverage, irrespective of whether this was limited company or individual, which is kind of against what kind of happens in the market. So normally for individuals, the lenders would stress at sort of roughly 145%, maybe slightly lower. So what we've seen is Fleet have just realigned themselves with the rest of the market. So now on individual applications, it's 145% coverage, but retaining the 125% coverage for limited company applications. Now, we've also seen Paragon repriced in the last couple of days. Their rates are now starting from 3.73%. Now, interestingly, we have seen a few rate reductions. Please don't get excited. This is not going to be a theme. I'll come on to in a moment why this has been happening. But what we have seen is Platform release some lower 5-year fixed rate deals. TMW have reduced their limited company fixed rate pricing by 0.15%, and their rates on 5-year money are now starting from 3.89%. The Commentary have also reduced their rates by up to 0.2%, and their rates are now starting from 2.95. Now, actually, I don't think this is a signal of things to come, and we're expecting a whole swathe of lenders putting rates down. These are lenders who would reprice upwards quite aggressively, possibly kind of really just trying to shore up their position in terms of interest rates. So essentially hedging against the movement in swap rates. So if we just put rates up at a really high level, we don't need to keep repricing every 5 minutes because ultimately we've got some real cushioning built in there. Other lenders have been pricing up with slightly probably more than they needed to, just to kind of slow down business volumes. The lenders are incredibly busy at the moment. Service standards are kind of blown out of the water. Things are very, very slow. So lenders will always, and even in times that aren't like this, when things are very, very busy, they will push their rates up to kind of slow down business volumes. So what maybe happened with these guys as well is just that simply they had put rates up to a point to slow business volumes down, their service is back on par, and they're now able to reduce rates back down to bring themselves back into market. So the real message here is that we're not expecting lots of lenders to start reducing rates going forwards, please be warned. Now, one thing that I wanted to talk to you about with interest rates this week in the lending market is I've had a few really interesting conversations with clients who are now asking for tracker rates, which is kind of really counterintuitive because interest rates are obviously climbing and they're expected to continue to climb. So to take a rate which is variable and therefore is kind of susceptible to interest rate rises feels very, very counterintuitive actually. But one of the chaps I was talking to came up with a really interesting point. So what he was saying is that actually he doesn't think interest rates are going to go up a huge amount further. So he's willing to kind of back the horse that says that I know my rates will go up, but actually because the variable rate mortgage that I'm applying for is relatively low comparable to the fixed rates, I think actually I'm going to come out better off for doing this. So essentially he's playing a bit of chicken with interest rates. Now I'm not saying this is the way to go, but actually if I give you the numbers to give you some comparables. So at the moment, and in the personal space, variable rates are now starting from 1.6%. A 5-year fixed rate is now from 2.29, so 0.6% difference. Limited company variable rates are from 2.89 versus 5-year fixed at 3.39. So actually what we've seen is the margin between variable rate products and 5-year fixed rate products grow over the last few months, which means there's much more leeway in terms of scope for the variable rates to increase before they surpass the fixed rate. So I think it's just really worth sort of flagging this up to you. Like I say, I'm not advocating taking variable rates by any means, because I do think we're in a period of time where we're going to see further rate increases. Incidentally, the predictions for the rest of the year, base rate will end at 2%, so that's 2 further increases by the end of 2022 and a further 0.5% in 2023. So we'll end the end of next year at 2.5%. Now these are predictions. They could be more gentle than this, and actually base rate could go up much more aggressively than this. This is just kind of what we're reading from various economists. But actually, if you're of the school of thought where actually you don't think variable rates or base rates is going to move much over the coming couple of years, then actually it could be that, you know, it's worth considering a variable rate option for you. One thing to note, there's often an assumption that variable rate products come with no early repayment charges, and there are products like this that do exist, but actually the majority of them, and particularly the ones where the pricing band is much lower, do come with early repayment charges. So you can't essentially take a variable rate now, plan on just jumping out of it. If things get a little bit out of hand, you are going to be committed for a period of time. Now, yesterday, after the resignation of Boris Johnson was announced, we were contacted by the press asking for comments on how we think this is going to impact things for landlords going forward. So I thought it was just worth sharing our views with you today. So I think there's kind of 2 key things here. There's the levelling up white paper and also interest rates, inflation, that kind of side of things. Now, in terms of the levelling up paper and all the things that are contained within that have been really quite contentious for some landlords, so the abolishment of Section 21, smart homes, landlord portal, all those kinds of things, I don't think there's going to be any changes to that going forwards, actually, with the new minister who's going to take the place of Michael Gove in the long term. I suspect things will continue as planned. However, there may be some minor adjustments, but what I'm not expecting to see is suddenly a massive U-turn on things like the abolishment of Section 21, I'm afraid to say. In terms of interest rates and inflation, so look, I do think a period of change in government could really hinder any meaningful changes that could have been brought in to really slow down the cost of living increases and inflation. So actually, I think for the near term, there's going to be no real impact. Actually, it could be a negative in terms of slowing things down for people. But really, I feel we're in a period of kind of transition now. And until the new Prime Minister and his new cabinet is actually announced, we're not really going to know too much in terms of future policy. So I think for the coming few weeks, I think just sit tight. I don't think much is going to change. And really, it's all going to kind of come out and be in the detail once we have the new cabinet in place. And lastly, this week, house prices. So the Halifax has released its latest house price index and has announced that once again the UK housing market has defied forecasts of a slowdown as prices have continued to rise, increasing by 1.8% in June, with the average price now at £294,845,000. So this increase marks the 12th consecutive monthly rise and is the biggest monthly rise since early 2007. The annual growth rate of 13% is also the highest since late 2004. House prices have risen every single month over the last year and are up by 6.8%, or £18,849 in cash terms so far in 2022, pushing the typical house price up to the record high. Now, according to Russell Galley, who is the managing director at Halifax, what he's attributing the continued growth to is, and you won't be surprised for us to hear this, is a supply-demand imbalance. So demand is still strong, although activity levels have slowed to be in line with pre-COVID averages, while the stock of available properties for sale remains extremely low. Galley has also said that property prices so far appear to have been insulated from the cost of living squeeze. And this is partly because right now the rise in the cost of living has been felt most by those people on lower incomes who are typically less active in buying and selling houses. And in contrast, higher earners are likely to be able to use extra funds saved during the pandemic, with the latest industry data showing that mortgage lending has increased by the highest amount since September last year. So look, how long can this continue? I think that is the million-dollar question. I don't think it's, entirely bulletproof, but at the moment the housing market does continue to perform really, really well, and things are not showing signs of letting out. I think really what we're going to need is a kind of wave of new properties coming to market to really slow down the house price increases. But at the moment, while there's still lots of people looking to buy, and that's massively imbalanced by the number of properties for sale on the market, house prices are going to continue to go up. And that's everything from us this week. Thank you for listening. I'm off to go and have a lem sip. If you do have any questions, please do give us a call, 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. Have an incredible weekend. I think the weather is going to be absolutely glorious, so do enjoy yourselves, and I will see you again same time next week.